Assalamu alaikum, this is Professor Muhammad Hassan Khan, and today we are going to start the lecture of week 9 of the course Credit and Risk Evaluation. So before wasting time, just move toward the topic, and in this topic we have to cover all the things about conceptual approach to the credit risk. So this is the content of this chapter. We are going to study the objectives, introduction, distribution of credit losses, conditional versus unconditional models, approaches to credit risk, aggregations, correlations between the credit events. So this is a quick view of the chapter. In this chapter we also have to cover, we have to discuss numerical, so which is a very important numerical, and so this is all from the chapter. So let's move toward our first slide, which is the conceptual approach to the credit risk modeling. So before just looking that, we have to understand what is the concept. We have already discussed credit risk in detail. So over here we are going to discuss that credit risk modeling. Okay, so the credit risk modeling is a systematic approach used by the financial institutions to assess, quantify and manage the risk of borrower defaults. It helps in making informed lending decisions, ensuring capital adequacy and discussing financial losses. Okay, it's a very simple definition. So what modeling says to us, it's a systematic approach. What systematic approach? Who use this? Financial institution use this. For what purpose? Assess, quantify and manage. For these three purposes: quantify, assess, now manage. What? The risk of the borrower. Why we are using this? For knowing the risk of the borrower. What are the advantages? It helps in making informed lending decisions. With the help of this, we are just informed lending decisions, like we are making the decisions, ensuring capital adequacy. So what is capital adequacy? I have already discussed. Before moving forward, just see what the capital adequacy is. Capital adequacy refers to a financial institution's ability to absorb potential losses, ensuring it has enough capital to cover risk. If I just simplify, like what capital adequacy is, like it is like the ability to absorb potential loss. Whose ability? Institution's ability, financial institution ability to absorb potential losses, ensuring, knowing it has enough capital to recover risk, to cover the risk. Like it have the ability, if any organization faces any kind of you can say that loss, so there must be a, like, institution must have ability to absorb that loss. Okay, mean to say that if any company faces any kind of losses, so after facing the losses, so they are not going to shut down. Other than that, they have the ability, they have some extra on side chance, so that they can run their business. Okay, some side, you can say that storage, or you can say that I am not getting the word, like they have some any kind of ability to recover that risk. Okay, they can absorb the risk. Okay, and reduce financial losses. So compiling all this definition, just read once again. Credit risk modeling is a systematic approach used by the financial institution to assess, quantify and manage the risk of the borrower defaults. It helps making informed lending decisions, ensuring capital adequacy and reducing financial losses. Okay, this is all from the conceptual approach to the credit risk modeling. Now just see introduction to the credit risk modeling. This was the objective. Okay, now talking about the introduction of the credit risk modeling. Credit risk modeling is a crucial aspects of financial risk management. It involves statistics and mathematical techniques to evaluate the default and the extent of potential losses. These models support banks, insurance companies, and financial institutions in assessing credit worthiness and setting appropriate credit policies. So, what introduction telling to us, like modeling is a crucial aspects of financial risk management. We are talking about the risk management in this whole topic, in this whole chapter of the credit risk. We are talking about the financial risk management. If you want to understand the financial risk, so you have to understand what the credit risk is. Okay, for that you have to go in depth with this chapter, with this course. Okay, so it involves statistical and mathematical techniques to evaluate, to know the default and the extent of potential losses. These models support banks and supported by that. Okay, now let's see what these things are. Credit risk modeling involve quantifying the probability of default, PD. PD is the short form of probability default, loss given default, which is LGD, and exposure at default, which is known as the EAD. To measure the overall credit risk, it uses historical data, statistical techniques, and machine learning models to estimate potential loss. Okay, so credit risk modeling involve these three things. Okay, let's see, move toward the next slide, which is the uses and application of credit risk modeling. This is the same topic. Over here we are going to discuss that what are the application and what are the uses where this credit risk modeling mainly used. First of all, loan pricing. How much interest to charge for risk? Like if any company, financial institution is approving loan, so with the help of credit risk modeling, they can understand, or we can understand that how much interest to be charged. Okay, help in loan pricing. Credit approvals. Should we lend to the customer? With the help of credit risk modeling, we are just making decision that credit approval, that if company is giving loan, so with the help of this modeling, they should know, they can make decision that should we or should they lend money to the customer or any customer. Stress testing. So we are going to discuss stress testing in upcoming chapters. So stress testing is like, what if the economy worseness, what is the worst situation of the economy, first thing. Second thing, what is the worst situation of the person, or what is the worst situation of any like company, anyone, any party. Okay, stress testing is known like we're testing the worst scenarios. Okay, fourth thing is like capital allocation. How much capital to reserve, like how much capital like to be like use, or you can say that safe side or like that. Okay, capital allocation. Portfolio monitoring, managing risk across all borrower. Like in portfolio monitoring, that what we are doing, we are managing the risk across all borrowers, like who are our lender, who are our borrowers. So we are monitoring everyone's portfolio. Okay, these are the uses of the credit risk modeling. Now moving toward the next slide. Objective of credit risk modeling. Okay, like the primary objective of the credit risk modeling is to quantify the potential losses arising from a borrower failure to meet their debt obligation. Okay, so we have discussed first thing, which is like simple, you can say that it was not the objective, it was about a simple view of the credit risk modeling, conceptual approach. Okay, introduction, objective. So let's see what the objective is. The primary objective of the credit risk modeling is to quantify the potential losses arising from a borrower failure to meet the debt obligation. This is a simple definition which we have already discussed from our previous chapter. Okay, I don't need to explain this in detail. Okay, first thing, estimate potential loss, reducing credit exposure, regulatory compliance, assessing borrowers credit worthiness. Okay, so just have a quick view on this, like objectives: identify expected and unexpected losses from credit default, reducing credit exposure, what it says, implementing the risk mitigation strategies based on model outputs, regulatory compliance, meeting banking regulations like Basel's Accord and SPP prudential guidelines. Number 4, assessing borrowers' credit worthiness, predicting the likelihood of loan repayment. Okay, like note, what is the Basel Accords? The Accords. So it's a Basel Accords are the series of international banking regulations developed by the Basel Committee on Banking Supervision. What is this? There's like committee, like in Pakistan we have the state bank to make the policies or any kind of regulation mainly made by the State Bank of Pakistan. And or internationally, if you're talking about international banking regulation, so the Basel Committee on Banking Supervision, it's short from BCBS, Basel Committee Banking Supervisions, aim to strengthening the global banking system and ensuring financial stability by setting capital requirements and risk management standards. Okay, this is the one who just make and maintain the regulation policies, each and everything internationally. Okay, so these are the few 1 2 3 4 objectives, and we have also learned what the Basel Accord is. Okay, now moving toward our main topic, which is the distribution of the credit losses. In this chapter, in this topic, we have to discuss, before that we have to have a quick view on the formula. This is the step 1 formula, step A formula, this is the step 2 formula, number 3 is the step 3 formula, and number 4 is like if we find the value of A and B, or like 95% or 99%, so we have to put interpreting the results, we have to put the value of 90% confidence level and at 99% confidence level. Okay, so let's see the distribution of credit losses. Distribution of the credit losses helps the financial institution estimate the potential loss from defaulted loans or bonds. It provides a probability distribution, possible outcomes of losses, allowing banks and investors to assess worst case scenarios and capital requirements. What distribution of credit losses mainly tell to us? Help financial institutions estimate the potential loss. What the potential loss is from the defaulted loan or bond. Okay, what the main potential loss from where? Loans or the bond. It helps the probability distribution. Okay, the first thing, like we have to know what the probability. In statistics, we have already discussed, or many people have studied, or have just know about the statistics. So in statistics, we mainly talk about the, like you can say that it, like for example, I give the example like certainty. Okay, in probability we mainly talk about the certain or uncertain things, like after 5 days it's going to be rain, or after 10 days it's going to be the good day. So we are talking about the probability. I give you another example, like if there is a match of two teams, Pakistan or India or Australia, so there are two teams, so there must be chances that Pakistan will be won or the India is going to win. Okay, there's a certainty, there's a probability, how much probability ratio that Pakistan or the India going to win the match. So the probability is not the exact thing, but we can calculate with the help of certain amount of data or with the help of certain amount of results. So we can predict the result, not the 100% result. Okay, so it's provided probability distribution possible outcomes. Okay, we're talking about the possible outcome of losses, allowing banks and investor to assess, to know worst case, that in future what going to be the worst case happen, worst case scenarios and capital requirements. In distribution talking about this thing. Okay, let's see to the formula. We can also understand this thing with the help of the numerical. So before doing the numerical, we have to learn something like steps or formula, which is very much important to do to perform any kind of numericals or to get any result. So over here we have divided this numerical into the different steps or a, you can say that for calculating expected loss. Expected loss is like EL, short form is EL, equals to PD LGD EAD. I have already told you that short forms of these things is going to be used here. PD is like probability default, LGD which is the loss given default, EAD which is the exposure at default, EAD, and the number of loans which is N. We're going to use this in upcoming steps. Okay, so the second step is the calculate standard deviation of credit losses. So standard deviation, or we sometimes we call it sigma or something like that. The name of this symbol is sigma, or many people mostly used to say the sigma, or someone say the alpha, it had different names. So over here we're going to call this symbol as a sigma. Okay, so which is known as the standard deviation. Over in step number 2 we are going to calculate the standard deviation. So standard deviation equals to under root n PD into 1 minus PD bracket close into LGD into EAD. LGD is like loss given default and EAD exposure at default. Okay, number third step, estimate losses at different confidence level. We are going to find the estimate losses with the help of Z model of statistics value. Calculate potential loss, we are going to find at 95% and 99% confidence level. Okay, loss at 95 level, 95%, and the value of 95% is that is equals to 1.645. Loss at 99% and the value of Z is 2.33 at 99. Again I am repeating, at 95% Z value equals to 1.645 and at 99 Z is equals to 2.33. You have to remember these two values. Okay, for if you will going to see this numerical in the examination. Okay, so the formula is loss at 95% equals to EL, expected loss, plus bracket open 1.645 into standard deviation. Okay, but if you got the correct answer of step number 2, so you have to put the value of standard deviation in the step number 3. If you are not getting the correct answer, so definitely your step number 3 answer will going to be disturb you. Okay, so try to make the correct answer, try to find out the correct answer of step number 2. Okay, so this is the formula of 95%. Let's see like what the formula of loss at 99%. Same formula, only the thing that is changing is the values, which is 95% value, which is 1.645, and at 99% we're going to see the value of 2.33. okay, so at number 4 step we are going to put the answers of these two, which is 95 and 99%. so this is the some requirement before. This is the pre-numerical requirements, formula and abbreviations and steps. Okay, let's start the numerical and let's see how numerical is going to solve. I have the 3 numericals. This is numerical number 1, numerical number 2, and numerical number 3. Okay, I have explained numerical number 1. You have to do numerical number 2 and number 3. I have write down the answers of this. You have to match the answers of these 2 numericals. Okay, let's see, let's start it. Consider the data of a bank with the number of loans which are 500. Number of loans which we are going to make the data. before doing the numerical, you have to read the numerical at least 2 to 3 times, and try to understand and try to figure out the data, that what data is giving you in the numerical. If you find and if you able to write the data correctly, then 50% chance is that you can find the correct answer of the numerical. If you are not able to detect, or if you are not able to catch the numerical question, so you are not able to solve the question. Most of the many things are written in the question, so you have to pick the things, you have to find the correct things. Like, see, consider the data of a bank with the number of loans which are 500, the probability of default which is 4%, and the exposure at default is 2000 20,000 per loan. The value of loss given default is 50%. So we have to find expected loss, A, B total expected loss, B, C standard deviation, which is sigma, D estimate loss at 95 and 99% level, which at two values, Z is equals to 1.645 and Z2 is equals to 2.33. At number E, interpreting results of both values. So these step is going to follow step number A, step number 2, step number 3, step number 4. Okay, I have added one more step. You can see, find total expected loss. So the the step number 2 becomes step number 3, step number 3 becomes step number 4, step 4 becomes step 5. Okay, so let's see how this numerical is going to solve. So probability default, which is 4%. You can say that probability default 4%. We are making percentage into decimal, so 4 divided by 100, so we got a 0.04 into decimal. Okay, second, and the exposure at default, EAD, exposure default EAD equals to 200 per loan. Okay, now talking about the value of the loss given default, LGD. What the value? We have the 50%, exactly 50%. If you convert this in decimal, so simply we have to divide 50 with 100, so we got 0.50. Okay, the number of loans, n equals to 500, let's use step number 1. Formula, EL is equals to PD into LGD into EAD. Formula, expected loss, step number 1, yes, step number A. EL equals to PD into LGD into EAD. Simply we have the things, we have to put in the answer. PD 0.04, LGD 20,000. LGD is 0.50. LGD and EAD is 20,000 per loan. After multiplying all this together, we got the answer of expected loss, which is 400. Second part, B part, wasn't present over here, but I told you we're going to use this number of n, so we are going to use number of loan over here. Okay, what it says that the answer which we get from the EL, expected loss, simply we have to multiply by this answer with the number of loans. You can see total expected loss at number B. What we have to find? Total expected loss equals to EL, which is expected loss answer, multiply by n is the number of loans. Okay, so EL is 400, n is in 500. 400 into 500, we got the answer. Total expected loss is 20,000. 2 lakh. Unit 10, 100,000, 10,000 lakh. Okay, we got total expected loss, which is 2 lakh. Now, moving toward the step number C, which is the standard deviation. So the formula for the standard deviation is sigma equals to under root n into PD into 1 minus PD into LGD square into EAD square. Okay, so putting all the values over here, n 500, PD given 0.04 into 1 minus PD. PD is like same 0.04. Now multiply by LGD, which is 0.50 LGD. We're going to take first square of this, okay? Then EAD, which is EAD is known as the exposure at default, which is 20,000. We have to use Demas rule, bracket, addition, subtraction. After putting, simply if you have scientific calculator, you put this in the calculator, brackets, each and everything, you directly get the answer of 43. Standard deviation credit loss is 43,43818. Okay, step number D, which is at 95%. Simply we have two parts. In part number 1, we're going to find at 95% formula EL plus Z into sigma. Okay, simply putting the values Z 1.645 multiplied by sigma value, which is the standard deviation value, which we find in step number 3 or step number C. Simply we are going to perform the mathematical performance. 400, we have to first multiply by this, then adding the answer of 400, then we got at 95%, we got the answer 72480.6, or if we're going to round off this, we got the answer 72481. Okay, now moving toward the B, same, only just putting the value of 2.33 of you can say that 99%. Simply solving this question, we got the answer 102,495.9, or taking the round off of this 95 become 96. Okay, number E is the same answer we got over here. We directly put this answer over here, 72. Okay, you can also just check the answer. I think there is some kind of changing which I have made in the class, so you can also put the same answer if you got from here. So same answer of D and E. Okay, so this is the solution of question number 1. So same numerical, but some values change. You have to match the answers of this by following these steps. Okay, so you have to practice this by your own. Question number 2, question number 3. Okay, let's move toward the next topic, which is the conditional models, also known as called the point in time models. What is the conditional models? Estimate default probabilities based on current economic and borrower specific conditions. What it says to us, a borrower default probability is 3% under normal condition, but during a recession, GDP decline and high unemployment, the model rises it to 8%. Okay, over here I have divided this topic conditional versus unconditional models. First, I have discussed conditional models. Secondly, I have discussed the unconditional models. After this numerical, I have divided this topic, conditional model versus unconditional model. So moving back, I have first discussed conditional model, unconditional model, then I have made the comparison of these two. I try to explain these two with the help of comparison. Okay, let's see what the conditional model tell to us. Estimate default probabilities based on current economic and borrower specific condition. It tells like if there any kind of default probabilities, it can be calculated, or you can say that it can be used. It can be like you can say that see this with the help of current economic situation and borrower specific condition. For example, I know you cannot understand this easily. Understand this with the help of this note. A borrower default probability is 3% under the normal condition, we're talking about the conditional model. Okay, the probability of a borrower's default probability is 3%. We are talking about if the borrower's default probability. Okay, under the normal condition. See, we're talking about this. But the thing, when the bird come here, but during a recession, what recession is like? Recession is like when the economy goes down. During a recession, GDP decline, gross domestic product, जो भी होती है, its full form, decline and high unemployment. The model rises 8 to 8%. In conditional model, the probability chances, the default probability is changed from 3% to 8%. Just mark my words, in conditional models, the default probability of a borrower change from 3% to 8%. Okay, when it happened, when the recession or GDP decline or high unemployment rate happen. Okay, just try to understand this. Reflect a real-time factors like GDP, interest rate, unemployment, borrower income, etc. useful for stress testing, forecasting, and delay and day-to-day task management. Default probability changes dynamically. This is the main thing. Over here in conditional model, it says to us that the default probability changing here, like I have given the example, from 3% to 8%. When it changing, when there is like any decline in the GDP or any recession come or under high employment rate. So this thing is happening. Okay, so reflect the real-time factors like GDP, interest rate, unemployment, borrower income. So where it uses for the stress testing. Stress testing is like unconditional or the most worst scenario. In the most worst scenario, we use the stress testing. Okay, just simply understand, conditional model is like probability default is changing. Now moving toward the unconditional. If you have understand conditional model, so you can easily understand the unconditional model. So what the unconditional model is: estimate default probabilities without considering current economic conditions. They assume a long-term average. Over here in conditional model, we are talking about the current economic borrowers. Over here we are talking about the long term without considering the current economic. Over here we are considering the current economic, but in the unconditional models we are talking about the without considering the current economic condition. We are not considering the economic condition currently happening right now. Okay, this is used for the long term purpose. Okay, unconditional model. So just understand with the example, a borrower is assigned a 3% probability. Over there also the borrower assigned 3% under the probability default. Okay, a borrower is assigned 3% probability of default based on their credit score and long-term default history of similar borrower, regardless of whether the economy is in recession or boom. Like there is a their like economy is going down or economy is going up. So the thing is like the probability of default will be same in all the cases if there is a recession or if there is a boom. Okay, in unconditional model. Over here it is changing. How it's changing? Due to the current economic situation. If the economy goes down, it's changing, or if economy goes up, it's going to change. It's not a fixed value that 8% or 9%. There must be any person over here. Okay, for making you clear. So just understand this, in conditional model the probability is changing. Over here in unconditional model the probability of default is not changing. Okay, you can see here default probability is fixed. we are using the word fixed or based on average historical data, not sensitive to current or short term macroeconomic condition. So what is the macroeconomics? So for understanding the macroeconomics, you have to study the course of the macroeconomics. So in I just give you the like upper thing over you can say that short about macroeconomics. In macroeconomics, we mainly talk about GDP, recessions, or the growth of the country, or anything. We mostly talk about the economy and GDP. Okay, okay. So the macroeconomic is like, okay, over here we're talking about the short term or the current economic situation. We're talking about the long term. Okay, but the main thing is like the main thing to learn over here, probability of default is going to be fixed. Okay, I have discussed the conditional and unconditional model in very detail, so you can also see the difference between in the conditional model and unconditional model in corporate economic and financial conditions. Like mainly depend on the economic and financial conditions. Assume that credit risk factor remain constant. Over here it's changing, it's become same. Use macroeconomics indicator to adjust default probabilities and dynamics. In macroeconomics, they talk about GDP. They are talking about the indicators of GDP is going up, down. Not Do not adjust for macroeconomic variables such as GDP growth or inflation or interest rate. Okay, example, we have talked about a stress testing model that adjusts default probability based on a GDP decline. Okay, stress testing model that adjusts default. They give the example, a static means like it's not moving, it's fixed, not changing. A static probability of default model where all borrowers are assigned a fixed default probability. Okay, over here the probability of default is changing. Over here all the defaulters all the borrowers are assigned fixed default probability. Okay, note, in business, stress testing is a technique used to test the resilience of instructions and investments portfolio against possible future financial situation. Okay, stress testing is like you got the future result or the most outcome result. Okay, so I have discussed the this conditional and unconditional model in very detail. So now moving toward approaches to credit risk aggregation. Our next topic is approaches to the credit risk aggregation. So what are the approaches? Credit risk aggregation means combining all the credit risks a bank or financial institution do they can understand the total risk they're facing from all their borrowers, loans and investments. It like adding up all the different ways a bank might lose money if people don't pay back their loans. To get a full picture of risk advantage, it helps bank to see how much total risk they are taking, make it easier to follow regulations and keep the bank safe from big losses, help in better decision making, like who to lend money to, who to lend the money to whom. Okay, like I just make this try to make you this thing in very 2 to 3 lines or 2 to 3 words. Like what the credit, so approaches to the credit aggregation means. Aggregation means the total combination. Like if you just understand the word aggregation over here, let's talk about what is the summarized answer of this approach to the credit risk aggregation is. Credit risk aggregation means combining all the credit risk. We are combining all the credit risk a bank or financial institution do. Like if we just dividing in simple chunks, but over here we are calculating the whole what risk of any bank, like where the bank, to whom, how many customers the bank have entertained for their loan policy, or how many borrowers do a bank have. So by combining all the borrowers, all the parties, or you can say that all in a single plate, we are just putting all the borrowers of a bank in one plate. We're combining them. Okay, so what is the advantage of that? So that they can understand a total risk. But if we are combining all, so we are getting a total risk. they're facing from all the borrowers, loans and investment. Okay, they're what they're facing from the borrowers, from the loan and the investments. Okay? It's like adding in the easy word, it's like in the adding up all the different ways of a bank might lose money if people don't pay back their loans. If they are just putting or combining all the things with the help of that, what's what advantage of that? Like bank might like adding up all the different ways the bank might lose money if people don't pay the loan back, back their loans, to get a full picture of the risk, like where we going to have the risk, what are like from which type of risk we're going to, from which customer we're going to have risk. Now let's see about what advantage it helps the bank see how much total risk if you combine all the risk, like if you're going to combine all the risk they are taking, make it easier to follow regulation and keep the bank safe from the big loss. By adding up all the risk, bank can be just safe from the big loss, help in better decision making, like who to lend money and whom not to lend the money. With the help of this approach of credit segregation, the bank is going to let's make the better decision of that. Okay, I've talking about what the credit risk approaches to credit risk aggregation is and what are the advantage of this. Okay, now moving toward the approaches to credit risk aggregation, simple same thing is defined here. Economic capital model approaches, second is stress testing, portfolio approach, loss distribution approach, LDA RAROC, which is the risk adjusted return on capital, and credit metrics and credit risk. These are the approaches. You can also just read what are they. Now this is the last topic of our chapter, correlation between the credit events. So what are the relation of credit events? Are credit events like defaults, bankruptcies and downgrades are linked because these all are linked with each other because they often happen together, like they all are things happening together. If any company or default, it become bankruptcy, or it's grade going to be down. And I think in our first or second chapter we have discussed about a different grading system like A plus or like that. So the company default become bankruptcies, or like its grade is going to be down. So these all things are linked with each other. They happen together. When the economy slows down, let's just understand it. When the economy goes down, companies earn less and struggle to pay. Earn less, like earn companies making profit less and struggle making less profit, and also what are happening, struggle, the company struggling to pay the debts. We're struggling to pay the debts, landing to more defaults. Like you can say that when there is a recession, or you can say that the GDP is going down, that companies aren't making any kind of profit and they're struggling to pay the debts, landing to more default. They are not going to pay their debt. Over here they need more money to grow, so they are landing the money, landing to more default. When they are going to land more money, they are going to become more default. Okay, if one company fail, like understand this thing, if one company fails, other in the same industry may also be affected. Like for example, if let's understand this, if any there is an example, like take the example of a you can say the industry of a manufacturing company, manufacturing of textile. If the textile A is going to fall any country, so automatically it affect the textile B. So like if A is falling, so because of the company, because of the economy of the country, economy of the country is going down, so the you can say that the companies are also not making the profit. There may be lots of reasons behind that. So then understand that A company also affect the B company when there is a bankruptcies or the country economy is going down. So You can just see the example in Pakistan. There are a lot of textile industry they are affecting, and after affecting, they are shifted from Pakistan to the Bangladesh country. So because the economy of the Pakistan is it's slowly going down due to the high rates of interest, or even the taxes, or many other factors, they are affecting to make the economy down. So the major downgrade can, where we were, if one company fails, other in the same industry talking about, may also be affected. A major downgrade can scare investors. What happening? The investor becomes scared. They were not able to invest money, making borrowing more expensive for businesses and governments. Like a major downgrade, what major thing happen? Major downgrade, that downgrade can scare investors, making borrowing more expensive for businesses and governments. Bank and lenders hold risky debt may also face troubles, spreading the impact. Companies and governments that borrow money are linked. So if one faces problem, it can trigger a chain reaction, leading to more credit events. Like you understand it, if because how these thing are interrelated with each others. Like if the economy goes down, the investors do not invest the money. They try to make themselves safe. They're just scared by investing the money in any company, and making borrowing more expensive for business and government. So if no investors, so it's hard for the business or the government to grow up. So the bank and lenders holding risk debts may also face troubles. Like bank, because most of the loans are provided by the banks, and there are the government banks also provide the loans. So to the company, government bank also provide the loan to the company. So the thing is like what happening, holding risky debt may also faces trouble. Like if there's a debt, risky debt means, like if we know that this company is taking a lot of debt, the company have to pay a lot of debt. So it's and that company situation is also going down. So this is the risky debt, known as the risky debt, and also faces trouble. So that the company also faces, not only the company but also the government also faces, because the government is not receiving the taxes, or and if the company take the loan or debt from the government bank, so the company have to pay back. So the company, for example, if that company is not paying back, so there is also the high chance for the governments to become falling down. Okay, companies and government that borrow money are linked. Company and governments just borrowing money are linked with each other. So if one faces problem, for example, if one faces problem, so another also face the problem. It can trigger a chain reaction, landing to more credit events. Okay, so this is all from the correlation. We are talking about relation, correlation between the credit events. So this is the example, or this you can say the best thing I try to explain you, and this correlation between the credit events. This is all from the chapter. I hope you try to understand this chapter. So we have discussed topics, and this, I think this is the biggest lengthiest chapter ever. So I tried to explain each and everything in detail,